You just got paid yesterday, and somehow your bank account is already looking sad again. You promised yourself this month would be different. You'd finally start saving, maybe even invest a little, but then your car needed new tires. Your friend's wedding gift, that subscription you forgot to cancel, and suddenly, you are back to square one. You are making decent money, more than your parents did at your age, but you never feel rich. In fact, you feel broke most of the time. What is going on? Here is the truth that nobody wants to say out loud. The entire system is designed to keep you feeling poor, even when you are not. And until you understand how this trap works, you'll keep running on that hamster wheel forever. I am Bob, and I've spent years obsessing over personal finance, digging into why smart, hardworking people struggle with money. I share practical strategies that actually work for regular folks, not just trust fund kids or tech millionaires. If you are tired of feeling financially stuck, you are in the right place. Don't forget to subscribe and hit that like button, because I am going to keep sharing content that helps you break free from the money stress cycle. Let me introduce you to a concept I call the lifestyle inflation trap. It is simple but deadly. As your income grows, your expenses grow right alongside it. Sometimes even faster. You get a raise. You upgrade your life. Better apartment, nicer car, fancier coffee, more streaming services. Before you know it, that extra $1,000 a month has evaporated. You are making more but feeling exactly the same level of broke. This isn't just my theory. Research shows that for every dollar increase in income, the average person increases their spending by 90 cents. Some people spend even more than they earn through credit. The gap between what you make and what you keep stays painfully narrow, no matter how much your salary grows. That is why people earning six figures often feel just as financially stressed as those earning half that amount. Let me show you how this plays out in real life. Sarah and Mike both graduated college together 5 years ago. Sarah started at $45,000 a year and now makes $65,000. Mike started at $50,000 and now makes $70,000. You think they're both doing well, right? But look closer. When Sarah got her first raise, she moved from a studio apartment to a one-bedroom. Cost difference, $400 more per month. She bought a newer car because her old one felt embarrassing in the company parking lot. Payment, $350 monthly. She started shopping at Whole Foods instead of regular grocery stores, eating out more with her work friends, taking those weekend trips everyone posts on Instagram. Her lifestyle grew perfectly in sync with her income. Mike did something different. When he got raises, he kept living like he made $50,000. Same modest apartment, same reliable used car, semi-reasonable grocery budget. He funneled every raise directly into savings and investments. After 5 years, Sarah has about $3,000 in savings and feels constantly stressed about money. Mike has $47,000 invested and growing. Same timeline, similar incomes, completely different outcomes. The only difference was the trap. Sarah fell into it. Mike avoided it. Here is another example that hits close to home for many people. Think about banking fees. Banks have designed an entire profit system around people living paycheck to paycheck. You run your account down to zero, maybe go a few dollars over, and boom, they hit you with a $35 overdraft fee. Then another transaction goes through, another $35. In one day, you can rack up over $100 in fees. Nearly 30 million Americans pay overdraft fees every year. With the average person paying around $250 annually, that is money going straight from struggling people to massive bank profits. If you have $250 to spare, you could invest it. Over 30 years at a modest 7% return, that single year's worth of fees would grow to over $1,900. But instead, it is gone, vaporized, making you feel perpetually broke. Or consider car purchases. The average new car payment in America is now over $700 a month. For a typical 5-year loan, you are paying $42,000 total. And that car loses about 20% of its value the moment you drive it off the lot. Meanwhile, a reliable used car might cost $15,000 with a $300 monthly payment. That $400 monthly difference, if invested instead over those 5 years at 8% annual return, becomes about $29,000. After 20 years of continuing that investment habit, you are looking at over $230,000. One car decision, compounded over time, is the difference between financial freedom and feeling perpetually broke. Now I know what you are thinking. First, objection. But Bob, I don't make enough money to save anything. After rent, food, and bills, there is nothing left. I hear you, and I am not going to pretend everyone has extra cash lying around. But here is what I've found. Most people have more flexibility than they think. It is not about having money left over. It is about deciding where money goes before it disappears into the void. Even $25 a week, which is less than 2 coffee shop visits, becomes $300 a year. That is an emergency fund starting to build. That is breathing room. The key is making the decision before the money hits your checking account, not after. Second objection. This sounds great in theory, but life happens. Unexpected expenses always come up. Absolutely true. That is actually exactly why you need to escape the trap when you are living right at your income level with no cushion. Every unexpected expense becomes a crisis. A $500 car repair isn't just annoying, it is devastating. But when you've been saving that gap between income and lifestyle inflation for even 6 months, that same repair is just an inconvenience. You handle it and move on. The unexpected expenses don't stop, but your ability to absorb them without financial trauma completely changes. Living below your means doesn't make life harder. It makes life's hard moments manageable. So what do you actually do about this? How do you escape the trap when you are already in it? First, calculate your real baseline. What does it actually cost you to live? Not your current spending, but the minimum you need for rent, basic food, transportation, insurance, and utilities. Write down that number. For most people, it is lower than their current spending. That gap between baseline and current spending is where your wealth is hiding. Second, implement the pay yourself first system. The moment your paycheck hits, automatically move money into a separate savings or investment account. Start with whatever feels doable, even if it is just $50. The key is automation. If you have to manually transfer money, you won't do it consistently. Make it automatic, make it immediate, make it invisible. What you don't see in your checking account, you won't spend. Third, freeze your lifestyle for 1 year. This is the game changer. Next raise you get. Next bonus. Next tax refund. Pretend it didn't happen. Keep living exactly as you are right now. Redirect that new money entirely to savings and investments. If you can do this just once, you'll break the inflation trap. You'll start building real wealth while maintaining the same quality of life you already have. Fourth, eliminate one money leak. Everyone has them. Subscriptions you don't use, eating out from laziness, not desire, online shopping when you are bored. Premium versions of things when basic works fine. Pick one leak, just one, and plug it completely. Maybe it saves you $40 a month, maybe $200. Whatever it is, redirect that exact amount to savings automatically. You won't miss it because you weren't really using it anyway. Fifth, build your escape fund before anything else. Forget investing, forget retirement accounts for just a moment. Your first priority is $1,000 in a basic savings account. This is your buffer between you and financial chaos. Once you have it, life feels different. You are not rich, but you are not one emergency away from disaster. Then build it to 1 month of expenses, then 3 months. This foundation changes everything about how you experience money. The truth is, feeling rich isn't about how much you make. It is about the gap between what you make and what you need. Someone making $50,000 and spending $35,000 feels wealthier than someone making $100,000 and spending $98,000. That is not theory. That is mathematical and psychological reality. The person with the gap sleeps better, stresses less, and has options. The person without it feels trapped no matter what their salary says. You've been taught that success means earning more, buying more, showing more. But that is the trap talking. Real financial success is quiet. It is the growing number in your investment account that nobody sees. It is saying no to things you can afford but don't need. It is the freedom to handle life's curveballs without panic. This isn't about deprivation or living like a monk. It is about intentionality. It is about making your money work for your future self instead of just your present desires. Every dollar you save from lifestyle inflation is a dollar working for you forever. Compounding isn't just about investment returns. It is about the compounding peace of mind that comes from financial stability. You'll never feel rich if you keep playing the game by the rules designed to keep you broke. But the moment you step outside that system, even just a little bit, everything shifts. Start today. Not tomorrow, not next month. Today, pick one action from this video and do it before you go to bed tonight. Set up that automatic transfer. Calculate your baseline, cancel that unused subscription. If this resonated with you, hit that like button and subscribe, because I am going to keep sharing the real talk about money that nobody else wants to say. Share this with someone who needs to hear it. Your future self, the one who is financially free and sleeping peacefully, is counting on the decisions you make right now. You've got this. Let's build that wealth together.